Being debt-free is not the same thing as being financially free. And chances are you might not actually be in debt. In fact, you probably aren't, even though you might think that you are. So here's the 5 steps that you can use to simply figure out, am I in debt and what should I do about it? Step number 1 is to understand your balance sheet. Now, before you freak out on me and think that we're going to talk about complicated accounting, a balance sheet is simply this: assets and liabilities. Assets are what you own and liabilities are what you owe. If you imagine assets as a stack and liabilities as a stack, whichever stack is taller is the one that wins. So if you have more assets than liabilities, you're in a positive net worth position because assets minus liabilities equals net worth. And a bigger asset chunk than liabilities means you're positive. That means you're in an equity or collateral position. Now, on the opposite side, if your liability stack is taller than your asset stack and what you owe is bigger than what you own, now assets minus liabilities is going to be a negative number. And that is negative net worth or debt. The definition of debt is negative net worth. So a liability is a loan, but that doesn't mean that you're in debt. Having a liability simply means you have an obligation to pay someone else. It does not mean you're in debt. Now, step number 2 is to understand your income statement. This is another accounting document that is present in your financial life, even if you've never thought of it this way. Your income statement is simply what comes in, your income, minus what goes out. So again, if you divided a piece of paper this way, wrote all of your income on top, all the money that comes into your bank account, and on the bottom half, you wrote everything that flows out. This is all of your monthly expenses, things like eating out and groceries and bills and the mortgage, all of the outflows on the bottom. Income minus expenses equals cash flow. Now, all of your liabilities or loans likely have a monthly payment associated. So those are going to be outflows on your expenses of your income statement. And that's the true pain point, because oftentimes those payments eat up a big amount of our income, meaning that we have less money to spend on other things. Here's where point number 3 comes in. This is understanding your debt to income ratio. This is a measure of your risk or stability that banks or maybe a mortgage company would use when they're looking at you and trying to determine if they should extend credit to you or give you a loan. They're looking at how much of your income on a monthly basis is used up by fixed loan payments. They really want to see this be under about 30%. And there are fluctuations from organization to organization. The more that you have used up in fixed monthly loan payments, the more risky you are because the less likely you'll be able to make that payment. So we want to have a smaller chunk of our money going towards loan payments. And here's where the question comes in. Do I pay off debt or do I keep it? Because if I pay off debt, I might remove that monthly payment, which is where I'm going to be able to increase my cash flow on the income statement, but it might actually be putting you in a riskier position. Step number 4 is to figure out how you can have more assets and more cash in your control. Think back to your balance sheet. This is where assets minus liabilities equals net worth. If you use all your extra money each month to pay down your liabilities, you reduce your negatives, and that will have the impact of increasing your net worth. But what if you use all that extra money instead of paying down your liabilities to pay up your assets and pay yourself into an account that you can control? That puts you in a position now where you could pay off those loans if you wanted to, if it was the best move for you, and if it put you in a position of control. But here's the question you want to ask yourself. What if I lost my income? Or what if I had a large monthly expense? What gives me most options and most control so that that doesn't wipe me out financially? It's having assets, not having no loans, that gives you that financial strength and peace of mind. Step number 5 is to increase cash flow. Now, the way that you can increase cash flow is to increase income or decrease expenses. But before you pay off loans and liabilities to increase that cash flow by removing that monthly expense, you want to think about first making sure that you have a strong emergency and opportunity fund so that you have cash in your control. And then you want to pay off those loans in the right order so that you increase your cash flow systematically and give yourself the most control in your financial life. In another video, we'll show you exactly how to do that. But for today, ask yourself these 2 questions. Do I have any payments that I owe to someone else at interest? If the answer is yes, that means you have a liability. That does not mean that you're in debt. So if you do have a liability, then use this question to figure out if you're truly in debt or not. Do I have assets, whether it be cash or a property or an automobile or rental properties or a business or investment accounts or savings that I could use to pay off that liability? If you do have the ability to pay off that liability, you're not in debt because you're in a positive net worth position. The question becomes, does it make most sense to pay off that liability, or does it make most sense to keep that asset and get that money working for you? This is why it's very important to look at your whole personal economy, not just one decision at a time, because you want the most control, the most options, the most cash flow, and the most security and peace of mind for today and for your future. Hey, thanks for watching. I really hope you liked this video. If you did, click the link in the description box below for more information. Like this video, share your comments, questions, and feedback in the comments section, and don't forget to hit subscribe to our YouTube channel.